Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm excited that you've decided to join us today. We do a weekly webinar live every Tuesday to help you learn the ins and outs of passive real estate. Today's topic, we're going to dive into the hidden wealth of depreciation. But before we do that, if you aren't currently on our PassiveInvesting.com list to be notified of additional webinars and tools that we have, I encourage you to join us at PassiveInvestingWithWhitney.com. There, you can get access to our priority deals. You can also get access to our weekly education, our monthly boot camps, as well as hop on a phone call with me one-on-one to discuss your investing goals. Now, today we are diving into the hidden wealth of depreciation. And again, we do these webinars so you can learn how to take your active income and turn it into long-term passive income and wealth. So maybe you've tried to invest passively before, but couldn't quite get comfortable making the investment, or invested in a deal before, but realized, oops, I've made a mistake, or you just simply want to sharpen your skills. If that's you, you're in the right place. All right, so a little bit about me, if this is the first time we're meeting. This is me and my crazy crew. This is the whole reason why I invest passively in real estate. And I started off actively investing in real estate. I was working a W-2 job and then became an accidental landlord, and then did several live-in flips and house hacks, and then transitioned into owning my own single-family rentals, then eventually multifamily buildings, and then partnering on larger deals. Over the course of 20-ish, 22-ish years, I've been able to acquire over 800 million in real estate, in residential real estate, commercial real estate, and I've done an immense amount of flipping too. But in my current role here as Director of Investor Education at PassiveInvesting.com, I get to help teach you, not necessarily so you can go through the same journey I did, but really the power of investing in passive real estate. Because really, at the end of the day, we are all over, in pursuit of one thing, which is to have 100% control and choice on how we spend our time. Now, I outline a lot of my journey in my book, Money for Tomorrow: How to Build and Protect Generational Wealth, published with Bigger Pockets. And again, throughout this journey, throughout even, documenting in the book, what that portfolio has allowed me to do is get this goal, okay? A lot of people, when I talk to them, they say, hey, I want to invest in real estate so I can have financial freedom. Well, financial freedom is really a tool to do what? That is the question, okay? And maybe you want to be location independent. Maybe you want to have more flexibility in your day job, or if you're running your own company, or maybe you just want to have more flexibility in time so you can create more impact in the world. And that's what we can help you do here at PassiveInvesting.com. By investing in passive assets like debt, like equity, we can help you generate that cash flow. And we're super proud of having over $400 million deployed in our PIC Real Estate Debt Fund 1, and then also $1.4 billion in our equity assets. Both will help you achieve your financial goal. Now, before we dive into today's topic, this is your call to action to join the Passive Investing Club. Join me here at PassiveInvestingWithWhitney.com. Again, you can see all the different benefits that you get by doing that. All right. People love talking about taxes. And one of the best tax benefits in real estate, one of the most powerful tax benefits of investing in, especially in buy and hold real estate, is the benefit of depreciation. Now, it's not attainable. Just because you buy a building doesn't mean that you actually get depreciation, right? Because we have to hold it in a certain manner. We have to play by the government rules. But let's first start off with, what is depreciation? Now, depreciation is actually an accounting methodology, right? So depreciation in and of itself is an expense that a person who owns real estate or even owns their own business gets to take. They get to allocate the cost of tangible or physical assets like real estate over its useful life. Okay. Now, there are a lot of people get confused. They think they're seeing, perhaps, the Trump tax cuts being renewed and they want 100% bonus depreciation back because they don't want depreciation to go away. Well, that's the confusion here, is because depreciation isn't going away because it's an accounting methodology. So let's break this up between what are the two accounting methodologies and what is actually the tax credit piece. Okay. So let's break this apart. So the two accounting methodologies are straight line depreciation. And essentially, and we'll get into the time links of depreciation here in a second, the different schedules, but that's the amount that can be deducted from the income each year as this depreciable item. Maybe it's a car in your business, or it's a piece of real estate. Okay, maybe it's even the computers that you own in your business. Okay, as this ages, okay, the IRS has a schedule and they say the useful life of a computer is 5 years. Okay, so you get to take that value of the computer and divide it by 5, and then you get, and in the straight line accounting methodology, you get to deduct X amount per year. So say the computer costs you $1,000, you can divide it by 5. Now you can deduct $200 a year. Okay, now there's a different type of accounting methodology that people can access, but they have to perform what we call a cost segregation analysis. Okay, when you perform a cost segregation analysis, you get to access what we call accelerated depreciation. Okay, so what is an cost segregation analysis? Essentially, what you're doing is you're hiring an engineer to go into a larger asset, say like a piece of real estate, single family rental, or a multi-unit apartment building. And that engineer is identifying all the different property related costs that can depreciate in 20 years or less. And they put together a report and they help you speed up the recognition of depreciation. So instead of taking depreciation equally over whatever the schedule is, and we'll go over schedules here in a second, we can speed up that depreciation to the first 5 years of the hold. Okay, so cost segregation analyses are amazing. They are a little bit pricey, but they help you recognize that depreciation earlier rather than, depreciation you might have gotten in year 20 can be fast forwarded to year 1 potentially. Okay. Accelerated depreciation is the largest business subsidy in the tax code. So when we take depreciation in a real estate property or in our businesses, we are essentially partnering with the IRS to help shelter our income. Okay. So again, those are the accounting methodologies. Now let's talk about tax credits. Okay, this is where people get confused. There is one type of tax credit out there related to depreciation, and it's called bonus depreciation. All right, now bonus depreciation was actually around before Trump's first term. Okay, we had 50% bonus depreciation. Right? But in the Tax Cuts and Jobs Act of 2017, we actually, that administration reallocated the depreciation schedule, and they got 100% bonus depreciation, and then it ticked down over several years, and then eventually is set to phase out in 2026. Right now, we are recording this episode in 2025. All right, we have not seen a new tax package from the current administration, so bonus depreciation is 40% and set to phase out after the end of this year. Okay, so that is a tax credit. Now, does that mean that it goes away? Not necessarily. Okay, we still get to revert back to using accelerated depreciation. Okay, so you can take bonus depreciation on top of accelerated depreciation. Awesome stuff to do. Okay, so I think a lot of people are confused. They think if this tax credit bonus depreciation goes away, that they no longer get depreciation. That is not true. We go back and just use the regular accounting methodology. Okay, so I wanted to make sure we kind of define depreciation, define the accounting methodologies, define what the tax credit that's currently existing today. But why should you, as a passive investor, actually care about all this? Okay, well, because you're probably looking to invest in real estate either actively or passively. If you're here, more than likely passively, is because you know that when you have earned income, that's probably the highest tax burdened income that you can get, whether it's through employment or self-employment, okay? Those are the two highest taxed categories is earned income. So if without leveraging depreciation, you're essentially missing out on tax savings that could increase your cash flow. You could lower your reinvestment capital, or when you miss out on depreciation, you're lowering your ability to reinvest capital, okay, lowering the speed of which you can scale your assets. And here's the thing, if you own your own rental property, the IRS actually assumes you're taking depreciation. Okay, so if you don't do it, you're double losing. Okay, now when we learn how to leverage depreciation appropriately, depreciation can allow investors to reduce their taxable income now and maximize the acceleration of investment velocity. So essentially, when you save on your taxes, you have more to invest. All right. So again, depreciation, you can talk to all the different tax strategies, accountants, even cost segregation professionals. They will all tell you that depreciation is the #1 way to legally reduce your personal taxes by sheltering income. And possibly this allows you, if you can drive down your adjusted gross income far enough, you might be able to qualify for additional tax benefits. Okay, this is how you hear of a real estate mogul who earns, say, $500,000 a year or more, and they have all these depreciative losses, and they can actually go on the healthcare exchange to get healthcare. Okay, they're using a viable tax strategy in order to access that. Okay, so let's get into some of the more technical. Now that we understand what depreciation is, why we should care about it, because depreciation is available to us whether we invest actively or passively in deals, okay? Let's talk about what are the different types of depreciation, because in my conversations with investors, they sometimes are confused. They were like, why would I get more depreciation in this particular asset, say a multifamily deal versus a self-storage deal, which qualifies under commercial property? Well, it's because the schedule that the IRS has set. Okay, so there's two main depreciation schedules in real estate. One is the depreciation schedule for residential properties. The IRS says that the useful life of a residential building is 27.5 years, be it a single family home, duplex, triplex, quad, up to 500,000 unit apartment complexes. They say the useful life is 27.5 years. Okay, it doesn't mean all the components take 27.5 years to depreciate. Like your carpet, your paint might have to be replaced, carpet, all that might have to be replaced more like in 5 years, some of it in 10 years, some of it 15, 20, and so on. Now, commercial properties, they say that they're built different. Okay, so the useful life of a commercial property is deemed to be 39 years. Okay, so it's a function of math. Right? So let's just pretend we are just using our first accounting methodology, which is what we call straight line depreciation, just simple division. And we have $1 million property. $200,000 of that property is attributed to the land. Okay, we can't depreciate land. Land stays land, right? It doesn't break down necessarily. If it's a residential property, okay, if we take $800,000 and divide it by 27.5 years, using straight line depreciation, we're going to get a tax deduction of $29,000 and change a year. Okay. Now, let's say this is a self-storage building, same $800,000, attributed to the building, but now we're dividing it by 39 years, not 27.5, and our depreciation that we can take per year drops. Okay, why? Because our schedule is longer. So we can only take 20,512 per year, right? So I'm going to get to this and really drive home this point at the end, okay? We don't want to let the tax tail wag the dog, so to speak here, all right? But this is something to kind of think of in the back of your head whenever you start investing in residential or commercial real estate. All right. Now that we understand the schedules, let's start getting into some of the nuances. I want to kind of compare and contrast because we have different ways as an investor that you can take advantage of depreciation, okay? You can either take no depreciation, and of course the IRS assumes you do, all right? But sometimes you might get stuck with a bad accountant who doesn't understand real estate, and they say, no, 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 don't take depreciation, okay? Because that's gonna red flag an audit, and all these things that simply aren't true, okay? People are given that type of advice, okay? Then we're gonna have investor number 2, Sarah, who's just gonna take straight line depreciation, okay? She doesn't see the value for whatever reason to invest in a cost segregation analysis. Then we're gonna have our investor number 3, Michael, who's gonna use accelerated depreciation. He sees the value of a cost segregation analysis, but for whatever reason, his accountant won't let him take bonus depreciation. And then we're going to have our ideal investor, Lisa, who maximizes everything. Now let's set the stage because I want to show you the math. I'm going to show you in a big grid on our next slide. Okay. Our property in this case is $1.2 million. All right. Now, 200,000 of that goes to the land. And so $1 million goes to what we call improvements, essentially the building, the fencing, landscaping, stuff like that. Okay. So essentially, we are going to be able to accelerate. Let's just assume in this example that we're going to only be able to accelerate 800,000 across the first 5 years of hold, right? Because only 800,000 of this building depreciates in 20 years or less, meaning there's another 200,000 that has to be depreciated between year 20 and 27 and a half. All right. So let's take a look at our 4 investors. How do they fare? Well, John, he pays higher taxes and he gets no losses back for reinvestment. He actually he loses out on his reinvestment capital and he pays $0 in depreciation. He's still taxed on all that income. But remember, the IRS is actually assuming that he's taking $36,000 a year, right? They assume at the very least that if you're going to own a building, you're taking that depreciation, right? Now we got Sarah. Okay, she's like, I'm going to do my taxes myself. I'm going to just take straight line depreciation. I'm not going to get any additional advice. She gets to take advantage of the 36,364 depreciative losses over each year, okay, which generates, if she's in the 37% tax bracket, she's generating 13,462 a year to reinvest back into her property, her investments, whatever. Okay, now Michael, he's a little bit more sophisticated. Okay, he's got leveled up. He's decided to go with the cost segregation analysis. He has a real estate CPA that knows most of it, but not quite everything. And he decides to do a cost segregation, which allows him to accelerate losses forward. Okay, so now he's generating same building. He gets $160,000 in depreciative losses for the first 5 years. Okay. And then it'll tick down after that. But those first 5 years, he's realizing a savings of $59,200 a year. Awesome. Okay. Then we've got Lisa. Lisa's super savvy. Okay. She is going to partner with an accountant that's going to help her do a cost segregation analysis, understands bonus depreciation. And in the first year alone, she's going to accelerate the depreciation, $320,000 of a depreciation to year 1, generating a tax savings in year 1 of $118,400. Okay. Now the depreciation does not change. You have the same amount of depreciation on the asset. Really, what we're trying to figure out with the accounting methodologies and bonus depreciation is when do you get to take it? Okay. Do you want to have $13,000-ish in savings for 27 and a half years, or do you want to realize $118,400 of that in year 1 so you can grow and scale faster? All right. Now, again, that scenario kind of laid the land for active investing, but we're passive investors. So we want to invest in a deal where somebody is like Lisa, smart, right? Taking advantage of accelerated depreciation and bonus depreciation. But how does that flow through to us as a passive investor? And what's the impact to that to us as a passive investor? Well, I'm just going to set the stage here. Let's say you're an investor and you invest $100,000 in a hypothetical deal similar to Lisa's, okay? Because of the depreciative benefit in year one, that asset might be able to realize 50% of its total depreciation that it could ever take in year one between accelerated and bonus depreciation. And assuming you're still like Lisa in that 37% tax bracket, okay, that means you're generating 50,000 in losses coming back to you in year one. And at 37% effective tax rate, you're saving 18,500 just in year one to continue to reinvest in your own passive investing. Okay, just because you're a passive investor, you can still find deals where you can participate in the use of depreciation. Okay. So that savings of 18,500 generates an 18.5% first year return just from the tax savings alone. Now, losses can be used to offset other passive income and other passive gains in your portfolio. Okay, there are other ways that you might be able to unlock those losses and use it against active income. Okay, we're not going to get into that in this particular webinar, but what this allows you to do is, as a real estate, this depreciation still, as a passive real estate investor, is a very powerful tax shelter. Okay. Now, the myth is here, what stops people from actually taking it full advantage of depreciation? Okay, right? We built the case. It seems like a no-brainer, right? This is where, like the title of the webinar, Hidden Wealth, right? We showed you same building, but 4 different ways people were looking at that building. One person is like not making any tax savings off of it, and the other person is getting $118,000 just in year one. Okay, but the myth is, some people believe if I don't pay taxes, that's bad. Okay, we've been trained to pay taxes. But the fact is, we get to organize our affairs as such to where we pay our fair share of taxes. And here's the thing, just because you as a passive investor get to use depreciation to realize losses so you can reinvest back into your portfolio, you actually still are paying quite a bit in taxes. It's just at the asset level. Okay, you're paying property taxes in the local market. You're paying payroll taxes for the people to run the investment for you, like maybe the property management team, stuff like that. Okay, taxes are just now at the business level, okay, at the local level and at the employee level. You essentially become a business owner, right? That's what the IRS recognizes when we step in to solve problems. Okay, yes, we get this phantom depreciation to lower our personal tax bill, but we actually are already paying taxes. We're just paying them at the business level. Okay, now here's another fact. Not all operators actually share depreciation, what we call pro rata, right? So this is imperative for you as a passive investor to ensure that you are getting your fair share of losses shared with you. Lots of shares in there, but right? You definitely, when you're talking to an operator, when you're looking at a deal, you want to make sure that you're getting your fair split of the tax benefits. Okay, now there's some considerations, right? Remember our first investor, John, the one that just decided not to take depreciation, right? His neighbor was an accountant who didn't understand real estate and told him, no, John, don't do it, don't do it, don't do it. Well, why? Why did that neighbor say, don't do it? Well, because they were probably thinking, don't take the depreciation, because if you sell it, you might have to be subject to depreciation recapture or a capital gains tax. But here's the thing. Remember, the IRS assumes you're taking the depreciation. All right, so we might as well use it. Okay, and then We are just going to have to work with our accountants to manage the depreciation recapture, okay? And then capital gains. All right, so if those two things are in play, if those are the two considerations that keep people from fully utilizing depreciation to build their wealth, what are some ways that we can actually get around those potential obstacles of depreciation recapture and capital gains tax? Well, we actually have 3 exit strategies from real estate, okay? One, we have a property that's selling. We can just take the gain. We can pay the recapture, pay the capital gains, and we could go buy a boat. This is called the consumption strategy. It's also called the poor man strategy, right? Because we're not locking in those losses and keeping them in our portfolio, all right? We can do what we call the reinvestment strategy. This is where the IRS knows they want us as the investor to stay in the game, because the government doesn't want to take over solving for housing. They want us as the investor to do it. So they're going to say, okay, Mr. Investor, you already invested in one deal. Let's keep that money working for you. And I'm going to allow you to keep whatever you earn from depreciation recapture, and let's not pay the taxes on those gains as long as you continue to invest in the ways that we need you to. Okay, this is called the 1031 exchange. Some people also call it the buy, borrow, and die strategy. Okay, meaning we're going to continue to level up our properties, play a little bit of Monopoly, until it's time for us to literally exit life, and then those assets can be handed over to our heirs with a step up in basis. Essentially, that bill for depreciation recapture and capital gains just goes away. Okay, that is a very powerful wealth building strategy. Now, somewhere in between, there is another strategy, because especially as passive investors, we're like, oh, I want to have the flexibility to move from multifamily to self-storage assets or move between operators, right? So we have another strategy you can take advantage of, which is the lazy 1031 strategy, meaning that when you have an asset exit, you can pay the gains and pay the depreciation recapture when that asset sells. And then as long as you reinvest it in the same year to generate another bucket of losses, okay, that bucket of losses can then offset what the tax bill that you created earlier in the year. Okay, we call that the lazy 1031 exchange. It's not a perfect wash. Okay, you're not going to get 100% wash of your tax liability, but it is something, a strategy to keep in the back of your head if you're like, ooh, my allocation with this operator got too big. I want to kind of spread things out, or I want to add a different asset to my portfolio. Okay, this gives you flexibility. The reinvestment strategy and the offset strategy are the 2 strategies that are going to generate wealth for you. All right. All right. This was a lot to digest. So let's wrap it up with some kind of key points here. And then we're going to open up for our Ask Me Anything part of the show. The key takeaways here, what I want you to know as a passive investor, is that depreciation is one of the largest legal tax shelters out there is. Okay, so let's learn how to appropriately use it in our portfolio. Okay, not every deal has to kick off depreciation. Not every deal should kick off depreciation, right? We've talked about this multiple times on the Passive Investing Made Simple show. We should have our portfolio allocated across all levels of the capital stack, meaning that we should be invested in some of the debt layers as well. And those don't generally kick off depreciation, okay? But that's fine. We'll have a large portion, a sizable portion of our portfolio that does, right? Even passive investors can benefit from depreciation's power, okay? So you don't have to own your own single family rentals. You don't have to be a landlord managing tenants and toilets and termites, okay? You can invest in other operators, multifamily deals, self-storage deals, express car wash deals, and access this, okay? But my other key point is, remember, tax benefits in general, depreciation, 1031 exchanges, these are kind of like the icing on the cake, right? We've got a whole other investment foundation that needs to be considered first. And if we can get that bump in savings by using depreciation to create a little bit of velocity in our portfolio, that's amazing. Okay. All right, guys, this is your call to action. All right. If you want to learn more, if you want to hop on the phone with us and learn what assets we have available for you that would help you leverage depreciation, join me at passiveinvestingwithwhitney.com and schedule your one-on-one call there. All right, guys, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show.